Okay, so we're recording this meetup, and let's see, everything we're doing today is purely for educational purposes, and we're not giving any specific trading recommendations. What we're showing you is how myself and Becky, who is the co-host and my trading partner, how we go about profiting from the futures markets. And we've been doing it the exact same way since 2007 or 2008. We've been trading in the exact same manner, using the exact type of trade management because it works for us. So when you find something in a market that works for you, you stick with it. So there isn't a whole lot of change. We've done very little tweaks for more profitability, but the same technical approach to finding potential trades hasn't changed. And the general approach to trade management has not changed in all these years because it works. All right. Along the way, please feel free to ask questions. You can, if you raise your hand, I probably won't see it in the Zoom application. So just unmute, ask a question, or type it in the chat window, and I'll see it in the chat window, and I will get to it as soon as I see it. But interrupt me as often as you need to, ask questions, get everything clarified that you need clarified. All right, but before we start, is there anyone who has never ever done anything with futures and knows nothing about futures at all? It's totally fresh, new to them. They've never seen them. They don't know what it is. Okay. And does anyone not understand a basic candlestick chart? Because everything we do will be with candlesticks. Does anyone not understanding a candlestick chart? If anyone does not, then let me know. Either type it in or unmute, and I will go over it real quickly. So we go over the charts and we make sure you understand what we're doing with candles. Okay. So today we are going to talk about managing risk. And when I say managing risk, it's literally how to control how much you can lose. So when we talk risk, it's not like, oh, it's risky to trade futures. It's not like that. Risk is the amount of money you can lose on a given trade. That is what risk is. And the way myself and Becky and anyone we coach manage risk is by having a set dollar amount on each type of trade we're doing. So if we're trading options, we might say we don't want to risk more than about $700 per trade. We don't want to risk more than $1,000 a trade, more than $1,500 a trade. And then on every trade we do, we risk approximately the same amount. Same thing with futures. If we're saying on futures we want to risk about $700 per trade, then when we calculate all of our stops and potential max loss, we don't want it to be more than around $700. If we're saying that we want to risk $1,000 per trade, then if we took a full loss in the position, it would not be a loss of more than about $1,000. It'll never be exact, but it'll be that neighborhood. So we determine in advance how much we are going to risk on a trade and then be consistent with it. If we can consistently control our losses, and we have done our homework in advance and our calculations in advance, and we know that on every winning trade, we're going to make at least a certain amount. And we know on every losing trade, we will not lose more than a certain amount. And we know what our expected win to loss percentage will be. The rest is just just basic math. As long as you have so many wins to so many losses, we're going to make so much money. Okay. What you see on the screen is the short list of futures products we actually trade. We do not trade any other futures products other than these. And a big reason we only trade these is because these have micro contracts available to us, which are 1/10 the size of the full-size contract. This means we can trade futures in a much smaller account. If you have a mega account, if you have $100,000, $700,000 in an account to trade, then you can trade whatever you want. But if you have a smaller account, let's say $10,000, even $5,000, $10,000, $20,000, you can still trade these strategies with micro contracts, which are 1/10 the size of the full-size contracts. All right. I'm going to switch displays real quickly to view. And okay, this is what you're seeing right now. It is on my now it's on my trading platform. I use Schwab Street Smart Central. And I'll take a look at currency futures. This is the margin requirements for the currency futures. Let's take a look at an example. If I was trading Australian dollar, I can trade a full-size contract, and I need about $2,000 just to open one contract. Okay, that's for the full size. But if I'm trading a micro contract, M6A, I need $200, 1/10 as much money. Okay, if this moves one tick, meaning if the micro contract, let's say the full-size contract moves one tick is $10. If the micro contract moves one tick, it's going to be $1 per tick. Okay, so everything is 1/10 the size. And just to show you just a little bit more about the contract size and what big a difference it makes in allowing us to trade, let's take a look at the index futures. What does it cost to trade the NASDAQ futures? If we're trading the NASDAQ NQ, it costs $22,000 to open one contract. To open one, that's not how much you can lose, just to literally open and trade one contract in the NASDAQ. You have to have $22,000 in your account to open and trade one contract. If you want to trade two contracts, you need to have $44,000 in your account just to open a position with two contracts. Not how much you can lose, just to even trade it in the first place. Okay, that's how much money you need to trade the NASDAQ if you're trading the full-size contract, even the E-mini. So, but if we're doing the micro, it's $2,200 is what you need in margin just to open a contract. 1/10 as much. This is why we trade the micros, because it gives a lot more flexibility for smaller accounts to be able to get the benefits of trading futures, but without needing a massive, huge account of several $100,000. If you have more money, great. Then you can trade whatever you want, whatever size contracts you want. But the reality is most people are trading less than $100,000 size contract in most cases. So this gives us the flexibility to trade the micro contracts and limit our risk by not having to have massive exposure in the thousands of dollars if a trade goes wrong. And we'll go over that a little bit. Before we continue on, do we have any questions before I move off of this chart or this table? Any questions at all? Just feel free to unmute and ask. Okay, so I'm going to go to this contract specification. Today we're going to look at the euro, one of the trades on the euro. And the euro, for the euro, we're going to be looking at trading the micro. And that's going to be M6E. And make a note that each tick represents $1.25. So go ahead and make that note, write it down somewhere. On the euro, I'm going to type it into the chat window. Euro 1 tick equals 1.25. And we're going to keep that number in mind because I'm going to be asking you to do some calculations with stop sizes, but you have to know how big a tick is. So every tick move is $1.25. Okay, keep that in mind. And let's take a look at the margin for the euro, the micro contract. Let's see, M6. I'm on index futures. Currency futures, here they are. And the euro M6E, the margin $291. Yep. So make a note, euro $291 or anything about 290. And that varies from week to week. So $290 is the margin for 1 euro micro contract. And Becky, go ahead and type that in also. I saw you were typing. The margin for 1 euro is $291. So please type that in. Okay. And we're going to use those numbers as we go along as an example. All right. So everything we do is done for futures is done in a business-like manner. Like many people, when they start out trading futures, we day trade. We sit around for hours and hours and hours, whether it's in the daytime or in the middle of the night or whenever someone tells us this is the best time to trade. They'll be sitting there at 2 o'clock in the morning Pacific time, trying to trade the opening of some market in Europe or something, or Asian markets. And you're sitting there for hours at odd times when we have other things to be doing, watching things go up and down and trying to make decisions in real time, using a platform which is inadequate for what we actually want to do. But most people don't realize that until they've lost a whole bunch of money. So what we found, and myself and Becky, we did the exact same thing, okay? But as we went along, like any other business, you start out working for every penny you make, putting in hours. But as time goes on in any profession, you eventually want to work less and make more money, not just keep grinding out every day for the same amount of money. So as time went on, we evolved. And what we found is that for the same amount of money you can make or lose day trading on intraday time frames, sitting there for hours and hours every day, is the same amount of money you can make or lose swing trading, sitting there for a few minutes every day. Okay. We do everything on daily charts. I have not looked at an intraday chart since 2009. I have no reason to. I have no reason to look at what's happening every minute. It serves me no purpose. All my decisions are made on charts which are not moving. All my decisions are made on end of day data, and then I place my trade with an entry, a target, a stop loss, and I walk away. Okay. We don't make money by having a high quantity of trades. We make money by having quality trades. Okay. So big difference. And so everyone starts out day trading. They try to get in all these trades, trying to figure out patterns and getting in and out. But like I said, as time goes on, and what happened is that we started surrounding ourselves with different people who traded differently than we originally learned. And it was people who traded their own real money. And it's a totally different experience being around people that trade their own real money for a living and are willing to share that knowledge than educational organizations selling you a day trading type of strategy. So everything I'm showing you right now is how myself and Becky actually trade. And this is how we go about making money in the markets and how we can plan ahead to know we have an expectation of making money. And big part of it is managing risk. All right. So I'm going to switch back to the handout. And if you look in the chat window, the link to where you can find the handouts on the website. Like I said, along the way, ask any questions whatsoever. Don't care what it is, ask question. So these are the futures which we trade. These are the ones that have micro contracts available. And not all futures products have micro contracts. So that's why we don't trade those. And just so you know, we don't care about why things happen. We're purely technical traders. If it has a chart, we can trade it. It doesn't matter if it's soybeans or the euro, or lean hogs, live cattle, oil, gold, it doesn't matter. We take our signals from the chart and nothing else. We don't care what's happening on the news. It means nothing to us, okay? The charts will tell us everything we need to know, and it's a matter of statistics. It's all about numbers, okay? So some of you have seen this strategy before. We're going to be using this as a baseline example, and then we kind of go from there. All right, so I'm going to first do some very, very simple math, and I want you guys to type in a value, when I ask you to. If I'm risking $1,000 per trade, meaning if I take a full loss, I will lose $1,000. On my winning trades, I'm averaging a 50% return per winning trade. 50% of 1,000 is $500. Okay. How many winning trades do I need to be profitable? If I take a loss, how many winning trades do I need to place to make money? If on a losing trade I lose 1,000, and on a winning trade I make 500, how many winning trades do I need to actually make money? Need a number. 3. Thank you, Gloria. That is 75% winning trades. Okay. That is the minimum, absolute minimum we need to have when we trade our strategies to make money. With the 50%, it means for every $1,000 you lose, you're going to be making $1,500. Okay. Minus 1,000. Then you have 2 losses. Now you break even, and the third win. Then you have two wins. So you have 1 loss minus 1,000. Then you have 2 wins. You break even, and the third win you make money. That's 75% winning trades. That's how we trade. That is literally how we trade. 75% wins, and we make money, and that is the absolute lowest value where we expect to make money. Our low end is 80%. Okay. We don't do anything less than 80% because we need a little bit of cushion and margin of error. So if we see a strategy on a particular strategy on a particular currency or index future where it's less than 80%, it could be 79%, 78%. We know mathematically it will make money over time. We don't have no problem with that, but we want to minimize the number of losses to have to deal with, and there's also margin of error. So we don't touch any future strategies that give us less than 80% winning trades. Okay. So using that same example we just did, if I had 1 loss of $1,000 and I had 4 wins of $500, then I'm going to lose 1,000. The next 2 wins, I'm break even because I just won 500 and 500, so I'm break even. And the next 2 trades will be plus 500, so I'm actually making 2,000 and losing 1,000. Okay, that is trading. Okay, what we're showing you today is going to be some of our worst case scenarios at the low end, where that's the absolute low end, and it depends on what decision you make, because we provide you information for stats and stuff and profitability for all the futures trades, and then you make a decision which combination of stops and targets you want to use. But we're going to show you worst case scenario. In real life, it actually ends up a little bit better, depending on what decisions you make. But we're showing you some of the worst case scenario with the lowest potential profit. There are people, I'm going to ask a question, and I want some brave people to answer it, and just answer it without thinking. If you have a $100,000 account and you're trading futures and you kind of know what you're doing, you don't make a lot of mistakes, how much do you expect to make in 1 year? Put in a dollar amount. You have $100,000. You're doing a pretty good job trading your futures. You kind of know what you're doing. What's a realistic amount of money, dollars and cents, that you expect to make in 1 year? Let's see who's brave enough to type in some numbers now. There's no wrong answer, but that gives me a feel for your thought process. You're trading $100,000, and and how much you expect to make in a year. James says 50K. Okay. Anyone else? Come on, brave people. Type in a number. 30K. Thank you, Barbara. Okay. So with the way we trade futures, it is realistic to expect, if you follow the rules, don't make too many mistakes. If you have a $100,000 account, it is totally realistic to make between a 20 and 50% return on your account per year. It is very realistic to make between a 20% and 50% return on your account per year. It doesn't really matter what size account you might have a $20,000 account. It's going to be the same type of thing. You might even end up making more than that percentage-wise, because you're going to be probably trading a little bit higher percentage risk per trade than a bigger account. So 20 to 50% annual return on the account is realistic with futures. That's probably a bit, the 50% is probably higher, way higher than with options. With futures, things are more exact and predictable. With the options, it can vary. So, but yeah, 20 to 50% annual return is very realistic and tradable. If you follow rules and do it the way we tell you to do it, and it's a discipline thing, and you have to go through some ups and downs and a learning curve, a little bit of a learning curve, but consistency. You commit to what we do for 6 to 9 months, and you're going to see the benefits, because it's just going to less of a learning curve with futures, probably 3 to 6 months with futures, and you'll be there. With options, probably 6 to 9 months, but 3 to 6 months with the futures, and you'll be pretty set trading out strategies. All right. I'm going to go through one example, and I'm going to be asking you for some numbers, and we're going to take a look at percentage returns. But before we go off here, I'm going to take a look at this here. Some of you, we're going to have seen this before. We're going to look for a bearish cross of the trigger lines. There's just 2 lines crossing down and a confirmation. And then we're going to take a look at some trade management. Okay, now I'm going to switch over to a chart, and then we will take a look at the example. And we're going to use euro as an example. And let's go ahead and take this trade right here. These lines are the trigger lines. This is in a bullish cross. This is plot 1. This is plot 2. When plot 1 crosses below plot 2, we're in a bearish cross. Plot 2 is a linear regression line, and plot 1 is a moving average of the linear regression line. So plot 1 is the moving average that crosses up, and it crosses down, and it crosses up, and it crosses down. Plot 1 is what we follow. So plot 1 is crossing below plot 2. Okay. So when we, over on the left side of the data box, it shows all the actual values, because you can't really see them on the right side. It's 4 decimal places, so you have to look at the actual number. All we're looking for is the first 4 decimal places. All right, let's take a look at how we do this. So euro. In this euro, we're looking for these 2 lines to cross down. That's our setup. Everything we do, I use terminology learned from Jake Bernstein, setup, trigger, trade management. The setup is going to be visually what you look for. We're looking for these 2 lines to cross down. So if we were looking at this, doing a daily evaluation, At the end of this day, did the lines cross down? Nope. Nothing else to look at. Next day, did the lines cross down? Nope. Nothing else to look. It takes seconds to do an evaluation for the strategy. Next day, did the lines cross down? Nope. Nothing to trade. Next day, did the lines cross down? Yeah. So after 2 p.m. Pacific, your data updates and you would have seen these two lines cross down. And this candle is red. It's not red because of the down day. It's red because there's an indicator that the colors candle is red or green that gives us a bearish or bullish bias. Okay. That's a super trend. That's available on NinjaTrader and other platforms if you know how to program it or acquire it. Anyone who I'm working with, we will provide you the indicators to use. So you have the exact same charts we have, and everything you have looks the same as how it looks on our computers. All right, so we see this. Okay, great. Okay, so now we're going to, I already know that with this particular strategy on this particular euro, it's over 84% winning trades. Okay. So we're going to decide, okay, we're going to place this trade. It meets our criteria. It's a valid trade setup, and it's over 84% wins. So what do we do? Or over 80%, excuse me. Definitely over 80%. So we know we're going to be entering this trade 10 ticks below the low of this day. So let's take a look at, so we're going to need our entry, our stop loss, and our profit objective. Okay. And it's all will represent a certain percent of the account. So let's take a look at our entry price. So please write this entry price down and also type it into the box. Entry price is 10 ticks below the low. The low is 1.1090. So we're going to have the entry at 1.1080. Entry price is 10 ticks below the low. See the low on the left side on the data box, 1.1090. 10 ticks below that is 1.1080. So someone please type it in. 1.1080 is our entry price. 1.1080. Please type again in the data box chat window. Okay, 1.1080. Thank you, Barbara. Now, our stop loss is going to be 10 ticks above the high of these last 2 days. So the highest, this high is 1.1177, and this high is 1.1176. So this is the highest high in these 2 days. 10 ticks above 1.1177 is 1.1187. So type in stop loss at 1.1187. 10 ticks above the high. 1.1187. Please type that in. 1.1187. Okay, so that's where our stop loss is going to be. 10 ticks above this high is our stop loss, and 10 ticks below this low will be our entry. Okay. Now we have to determine our risk. We know our entry, we know where our stop loss is going to be per plan. And you know, and we know the stop loss because this is me telling you where it's going to be because this is our strategy and how we approach trading it. Okay. So, and for each different strategy we have, it's a grouping of strategies we trade. Each might be a little bit different where the stop loss goes or how to enter, but it's all the same type of concept. Okay. Now, what is the difference between 1.1187 and 1.1080? So you see in your chat window the two values. How many ticks difference is that? So 1.1187 minus 1.1080. Difference between 1.1187 and 1.1080. 107. It's 107 ticks. So 0.0107 is 107 ticks. Each tick, remember, is the $1.25. Okay. Each tick is $1.25. So for one contract, one micro contract. So what is 107 times $1.25? Type it in. What is a 107 times $1.25 is what? 133.75. Okay. So now we know if we took a full loss on one contract, we're going to lose $133.75 plus whatever fees you or commissions you might have to pay. So if we lose on one contract, we lose $133.75. Okay. So now we know our risk on one contract. Let's say we want to risk $1,000 total on this trade or per trade. How many contracts can we buy? We could do everything. We manage our risk. We're going to risk $1,000. So to do that, it's $1,000 divided by 133.75. $1,000 that will determine how many contracts we can get. What's $1,000 divided by 133.75? What's that value? 1,000 divided by 133.75. About 7. Okay. Is that exact, Olga, or rounded up or down? I'm assuming rounded slightly. All right. So according to Olga, we can get 7 contracts. Rounded down. Okay, good. 7 contracts. All right. So now, what do we know? We know that we can buy 7 contracts if we want to risk about $1,000. So what is the exact risk now? What is 7 times 133.75? Let's get an exact number there now. 7 times 133.75 is what? Let's get the exact number. If we take a full loss, we risk $133.75 with 7 contracts. So 7 times 133.75 is what? You're going to type it in. 7 times 133.75. Okay. So now we know our exact risk is $936.25. That's our exact risk. So we try to risk 1,000, but it'll never be exactly 1,000. Okay, it's always going to be plus or minus a little bit. So keep that in mind. But if our goal is to risk $500, it's always going to be 500 plus or minus some. It's never exact. So we know our exact risk is $936 if we take a full loss. All right. Now let's calculate a profit target. What we usually do, we provide profit targets that are 40% of the stop of the risk, 45% or 50% or 60% of the ATR. We show you different types of ways to make money with profit targets, and then you choose the one you want that fits in with your trading style and personality. Let's go with the in-between value, a 45% of the risk. So we know how big the stop loss is, and it's 100 and hang on a second. The stop loss is 107 ticks. That's how big the stop loss is. What is 45% of 107? 45% of 107 is what? Doing an in-between target. 45% of 107. Type it in, 45% of 107. 48. Okay. So what I mean by that now, we know our stop loss is 107 ticks. 45% of that is going to be our first profit target. All right. So our entry for this trade is 1.1080. What is 1.1080 minus 0.0048? 48 ticks below the entry. We get short on a trade that's going lower with a sell stop. So until the price of this market goes below our entry price, we don't get into the trade. The market has to be actually going lower for us to get into it. So 1.1080 minus 0.0048 is what? 1.1080 minus 0.0048 is what? 1.1080 minus 0.0048. $1.1080 minus 0.0048. What's that number? 1.032. Okay, Olga, that's going to be our first target. 1.1032 is right about here. So our first target is right about here. So when we see this trade valid, we have our entry price is 10 ticks below the low. We have our stop loss 10 ticks above the high. We know how big our stop is. It's 107 ticks. We know that represents $133.75 per contract times 7 contracts is going to be $936 total risk on the trade. Okay. When the market goes below 1.1080, this day it went down as low as the 1.1051. So our market went lower the next day. So our order gets filled. After this day is over, all we do is place an entry that says sell stop, 7 contracts. 1 triggers 2. So when that first order executes, the sell stop, when the market goes below 1.1080, it gets stopped into a trade, meaning now we're getting short 7 contracts, and that triggers a 1 cancel other bracket order that puts it in that bracket order. It'll tell us our target is 1.1032 and our stop loss is 1.1187. All that can happen anytime in the next 2 days. Once we place that order, there's nothing else for us to do but walk away and go live our lives. After a couple of days, the order will either get filled, or after 2 days, we cancel the order. There's nothing else to do. There's no sitting there in front of a computer waiting for things to execute, to go up and down. This takes 5 minutes or less, depending on how quickly and how accurate you are on checking things. It takes literally minutes to get this order placed, and you've done your work for the day. Okay, and there's nothing else to do. If it's order filled, it'll either be a loss or it'll be a 45% return. So let's do the math on the actual profit now. So the next day, the order is filled, but it didn't reach the target. Okay, it didn't go low enough. Take a look at the data box. It did not go to 1.1032. The next day, it went up against us, but it did not hit the stop because the stop is above this high. The next day, the stop was not hit, high 1.1177. The stop is at 1.1187, so the stop's not hit. And then it drops, hits our target during this day. Okay. We'll calculate a profit in just a second. We had 3 days to get into this trade. The signal day is valid right here. The next day, the entry triggered, but then the target was not hit. It actually went up. So you could have gotten into the trade on this day because the target's not hit. As long as you're above the entry price, you get in. The next day we can get in because the target has not been hit yet. You have a valid trade entry that triggered and then went up. If you get in on this day, you will now have a better than expected entry. So your stop loss will be smaller, but your profit target way bigger because you're getting it at a better price. You could have gotten in on day 3 before the market dropped. You get in anywhere up here. Your profit target could be more than double what it was going to be. So instead of having a 40% return, you could actually end up with a 70, 80, 90% return because you're getting it at even that much of a better entry price. And then it drops. Okay. So what we show in the spreadsheet, I'll be showing you are worst case scenarios, not best case. We show you the worst case scenarios. This is a trade where you could have gotten in, if you got in per plan, you're getting in down here, and then 3 days later, the market dropped. But if you got in on day two, because for whatever reason, you have a life, you have family activities, you weren't well, you were traveling, it could be any reason whatsoever. You didn't get the trade placed this day, you weren't around. The next day you come and look to see, hey, what trades did I miss this week that I can still get into? Hey, this one triggered, I can get in at a better price. These are the type of trades Becky loves to do. And so do I, because we can't always be there because we have other things we're doing. So sometimes you miss the original trade, but it hasn't reached a target yet. You get in a better price. You get in over here, it's like, hey, these are the ones I actually love because this can come all the way close to your target. And I could be, and here's the way I think, it's like, well, I'm literally 10 ticks away from my stop loss. Let me get in now. I can lose 10 ticks or I can gain a couple hundred. Risk reward thing. You get in at a better price than expected. The probabilities don't, it's still 80-something% chance my target will get hit. Doesn't matter where it's at, as long as I'm not stopped out, there's 80-something% chance this market all the way up here was going to drop down to my target. But almost all of a sudden, my 40-something% return becomes 80-90-something% return. All about decisions we make and reality of life. We can't always all get to our trades in a timely manner. But even if we don't, the trade is there, the money is there waiting for us. Okay, just have to recognize it and place the order. All right, so let's take a look at the actual percent return now. During this day, we got our 45, our first target is hit, our 48 ticks, not a problem. Okay, we have 48 ticks worth of profit at $1.25 per tick. What's that dollar amount? What is 48 times $1.25? 48 times $1.25. That's the profit on one contract. Someone type it in. 48 ticks times $1.25 was 48 times $1.25. Please type it in. $48 times $1.25. Waiting for someone. 48.60. Okay, that means on one contract we're going to make $60. But we have how many contracts? 7. What 7 times 6 is? $420. That's how much money we would have just made on this trade. Let's calculate our percentage return. What's 420 divided by 936? Because we're risking $936. So what's 420 divided by 936? That's the percentage. 420 divided by 936 is what? 44%. Okay, this is 44. So when we did that 45% of the stop loss, it's literally the same percentage return we're going to see on the trade. So our first target gives us a 44 to 45% return on our money. So that's how, if you risk $1,000, you have a 45% target, you're going to make $445. If you have a $936 actual real life stop and it's a 45% return, came out to $420. That's at the first target, worst case scenario. Okay, so this is how we trade. Now, this is all in, all out. This is easy. This requires no position management. This is literally just grabbing your money and walking away. If you want to do more work to make more money, you can do that by taking part of your position. Let's say you have 7 contracts. You might want to sell 5 at the first target and then trail your stop on the remaining contracts and see if you can make more. So that's those scenarios that happen, and you can work through that. If you did that, this would be a good example of where you can make more money, because you can, sell 5 contracts at the first target somewhere right about here, and then you move your stop loss down to break even, and then see if you can get more out of it. As the market keeps dropping lower, you keep moving your stop loss lower and lock in more profit on the remaining contracts. So those are all options we have. Then people can choose to either trail stops on remaining contracts, or if they don't want to deal with that hassle, you grab your 45% return and move on to the next trade. I like a lot of carefree trading. Most of my trades, I just grab my money and run. I take my 40. I know I'm going to be at over 84% winning trades overall, realistically. So I just grab my money and run. I take my 45% return, next trade. I have other things going on. I don't always want to be having to manage positions and micromanage trades and trail stops. So everyone's different. But this is what I like doing. I just grab the money, next trade, grab the money, next trade. Do you have any questions so far? But this is how we place every trade, and we control the risk by having a set dollar amount, which we risk on every single trade, and we're always in that neighborhood. So if we're risking 700, we're about, it's never going to be exact, but it would be about 700. Risking 1,000, like we just calculated, in real life, it was 936. Because there's only 7 contracts. If it was, so it won't be exactly 1,000. So it's always at plus or minus in that neighborhood. And that's how we control the risk. And we can never, ever, ever have a big loss. What kills you is having a big loss. If you risk $2,000 on one trade, risk $1,000 on another trade, what if you were to get a loss on the one where you risk $2,000? How are you going to make your money back? How many more? The numbers just don't work themselves out. If you're making 400 something dollars on a winning trade, and you suddenly take a $2,000 loss on one trade, and when you start doing all the math on it, it's really, really tough and you can't plan it. I can plan my income. I can literally plan to make money. I know each year I'm going to make money trading. The strategies, and I know over time I'm going to make money. It's predictable. Okay, any questions so far? I said everything I do is from a business point of view, all by the numbers. I don't care about why. Couldn't care less. I don't care about the talking heads on TV, on podcasts, whatever they want to do. Couldn't care less. What I do like to see once in a while, if I have a short on and they're talking doom and gloom on TV, yay, market's going down, I'm short, great. It'll just make me feel good, but it doesn't influence my decision making. If I hear them talk, if I'm long and I hear them talking about how great the market is and the market's going up, great, but it doesn't influence my decision making in trades. The charts do, and my trade signals do, and I follow my plan. Every mistake I've made in trading where I've lost money, a significant amount of money, is when myself and Becky, both of us, went off plan. As long as we stay on plan, we've consistently made money over the years, and almost every year we make money because when we stay on plan. When we go off plan is when we take losses. Okay. All right. So I'm going to show you. Some people don't always understand the big picture and the reality of the big picture of trading. So I'm going to go through some of the trades over the last couple of years, which I said I do in the meetup write-up, because you really have to see numbers to understand how things work out. Otherwise, it doesn't always make sense. So what indicative lines do you have on a chart that cross up and down? Those are the trigger lines. So James, those are the trigger lines. That is the one where the plot 2 is the linear regression line, which is available on pretty much every platform. And the one crossing up and down above and below the linear regression line is a moving average of the linear regression line. For NinjaTrader, I will provide all that. And if you have Thinkorswim, I can provide that too for you on Thinkorswim. I have those indicators available. But that's for this particular strategy. We have a grouping of strategies that use different charts. This is for this particular strategy. We have long strategies, short strategies. Some of our long strategies, the short strategies we have, is a certain concept we use when we trade certain strategies, where we look for trades to go below a certain level. Like if this was the previous swing low right here for the indicator, let's say, as a concept. This indicator went low here, and then turned up. So we look for where we close below it. Here, we might have a trade here. So those are different concepts we use when we trade. Here, we swing low, close below, new trade. So that's so we use different indicators for that, but that's how we trade and some of the concepts we use. So we use a lot of similar concepts, but different points in where we get the trade signals. So you can't find every single short trade from this. This is one trade. A different strategy might give us an entry over here. A different strategy might give us an entry up here. That's how we trade. So we might have 3 different short strategies. One gives us an entry up here. One gives an entry right here. Another one gives us an entry down here. And we trade them in conjunction. So that's how we get buy signals in a similar way, with different strategies giving us entry points at different places in the trend. All right. So what you're seeing here, people have trouble seeing the big picture of any particular strategy or approach to trading. So I asked Becky a while ago to put together all the valid trades for the last several years to see if, when we look at them big picture, how the numbers work themselves out if we have disciplined trading and strict risk management. So we did this based on having a $50,000 account and risking 2% of the account per trade, which is $1,000. Like I said, it will never be exactly 1,000. This could be a $25,000 account. This could be a $10,000 account. Okay, it doesn't matter. It's percentage. It's based on percent return, not about actual dollars and cents. If you still think about trading and making money in dollars and cents, that is something you really have to think about adjusting. Because for trading, it's all about percent return, all about percent return on account. It doesn't matter whether you're trading a $20,000 account, a $50,000 account, or $500,000 account. They all work the exact same way. If you want to make more money, have more money to begin with. Okay. So you don't just double your account size overnight, that type of thing. Some people do that, gamble and get lucky and lose it again later on. So it's not about how much money you make, it's about percent return on the account. So the same people trading a $500,000 account will place the exact same trade as someone trading a $50,000 account, and place the exact same trade as someone trading a $10,000 account. The only difference is the number of contracts you're trading. That's the only difference. And a person with the $500,000 account won't be trading micros. They'll be trading full-size accounts. Same trade, exactly the same, except they have a bigger account. Okay. All right, let's take a look at this. We're going to go month to month, and then take a look at reality and take a look at mindset, because mindset is what messes people up, not the actual numbers and stuff like that. What goes on up here is what messes with people's head and losses. Let's take a look. Started January 2019. Now we have this data that goes back to 2003. We have 20 years of all of this data. I just asked Becky to assemble this for the last couple of years as an example for the presentation so people can see. But we have all the data for every strategy, for every futures contract going back 20 years, for every trade that's ever been valid, win-loss, so on and so forth. That's how we establish our everything. Goes back 20 years. Okay, I need to change the share back. Okay, I'm going to change it. Thank you for letting me know. Okay, I'm now back on the spreadsheet. Okay, so we have 20 years of data for everything we do, for every strategy, for each one of the currencies, for each one of the index futures. But I asked Becky, like I said, to show us at least several years worth of data and wins and losses so we understand how money is made. So we base it on a 50 grand account to make the numbers easy, which is $1,000 per trade. But like I said, this can be a 20 grand account. It can be a 10 grand account. That's all okay. January, we had a net loss, 2.3%. Sometimes this will discourage people. Let's say you started trading with me at the beginning of the month. You trade your very first trade you place is a loss of $1,000. That sucks. First trade you place, use $1,000. Did exactly what I told you to do. You see this one says 25, that's 25% return for that particular trade. 42% return, 34% return. And then you had 2 losses end of the month. And you're crushed. You spend all month doing everything. Note, we don't have a lot of trades. We don't look for quantity, we look for quality, not quantity. When you're starting out, you look for lots of trades. As you go along, you're more relaxed. You look for quality trades. And you think big picture, not one winning week or one winning month or one winning day or stuff like that. You have to expect wins and losses, okay? So this month, 2.3% return, let's be negative 2.3. The next month, February, we had a couple of wins. And all of a sudden, these 2 months negate each other. So we are break even for the year. March, we had several trades, all winning trades, 4.3% return on the account, $2,000. Keep in mind, this is a 2% account risk. If we were risking 4%, this would be $4,000. I wouldn't recommend risking more than 3 to 4% because of margin issues, okay? And we keep going. April, all wins, 4.8% return. May, 5% return. Longs and shorts, this is just taking every trade. As long as you can afford it, as long as you have the financial resources, you take every valid trade. You take every valid trade as long as you can afford it. If you have a smaller account and you can't afford to take every valid trade, then you're gonna have to pick and choose. But if you have less money, don't assume you're going to get the same results as someone that has a whole lot more money. It's the same in life. You are not, people who have more money can do more things than people who have a lot less money. Same thing with trading. Okay, so back that's the same reality. If you have more money, you can accomplish more things. Same with trading as in real life. Okay, so note this keeps adding up. Just keeps adding up each month. Adding up. This is a really, really good month of July. Really good month with no losses. The money adds up real fast. Okay. October is usually a nice month. I look forward to every October. This is why I always put forth in all my presentations. October through April is when I really would like to trade, especially October, especially end of the year, October through December. Really good time to trade. Okay. It can be disproportionately good trading. And this is now annual. For the year, made $22,000. If you were trading 3% of the account risk, this would be 33,000. If you're trading 4% account risk, this would be 44,000. If you were trading a $25,000 account, this would be half of that. If you had a $25,000 account and you're trading 4%, it's still $22,000. Why I like futures so much is because I know as long as I maintain my 80-something% wins, I know I'm going to make at least so much money. Options doesn't give you that advantage. Options you don't know how much you're going to make with options, so it varies. With futures, I know how much I'm going to make. And it's always a good year trading futures as long as you're consistent. Okay. All right, so we go into 2020 when everything was going all to hell and everything was shutting down. Here's our 2020 trading. February, March, things kind of went haywire. This is the month when everything shut down. Okay. So we had a couple of long losses, but then the market turned bearish and dropped. And overall, we had a really, really nice month of February, as long as you're consistent with your trading. Losses happen. You have to put them out of your mind and place the next trade. And that's by trusting your methodology, trust your strategies, your trading, trust the methodology, and stay with it no matter what. You have to, once you know you have something, you've done your independent back testing, you know it works. Even if you get a bunch of losses in a row, know that at some point in time you will get 4 to 6 consecutive losses. Learned that from Jake Bernstein. And a lot of people don't think like that. After they get 4 or 5 losses in a row, they change everything. They panic. They think everything stopped working. No, that is normal. You will eventually get 4 to 6 losses in a row. And that's normal and expected. And once you understand that, then when you get those losses, you double check and make sure you didn't make any mistakes. Those losses will, as long as they're valid losses, keep going. And keep place the next trade, place the next trade. But this all requires you to place the trades. You might have 2 or 3 trades on the same contract. You might have 2 or 3 trades on the ES. You might have 2 or 3 trades on the Russell at the same time. That's normal. You're only trading a couple of contracts. You're going to have multiple trades on the same contract. Okay, it will happen. And you have to understand that and place the trades. Each is managed independently of the other one. Okay, moving on. We went from a short market to one of the biggest rallies in market history as the markets turned around at the end of March and into April. We went from sell, 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 sell everything to long, 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 long everything. Okay, so here was March, really, really good month of trading. This is when everything was going to hell, okay, and because of COVID shutdowns. This was some of my best trading ever. During that time, my entire reality shut down. I teach fitness classes. All fitness classes are shut down. Everything shut down. I train in jujitsu. Jujitsu, where we're grappling and people choking you out and in your face, and all that stuff was done. We couldn't do any of that, at least for a little while. So all the stuff I normally do is shut down. I didn't have any place to go, nothing to do. So what did I do? I focused on my trading. I didn't have all my sources of income were shut off. So I'm like, well, what am I going to do now? It's like, because I have multiple streams of income. I do this, I do that, I do that. I work on films. All my commercials and films were all cut off. Everything was cut off except for trading. This was literally my only income that never changed. It actually got better during COVID. It got better. I think part of it is because I got more focused. I had nothing else to do. So I'm going to make sure I'm in every single trade. So between this and options, this was a great year of 2020 for me of trading. Because of COVID, because I was so focused on it. I had nowhere else to go. So let's improve on the strategies, get more profitability, trail more stops. Really, really good year of trading. Let's keep going on this. And the good trades just kept on going, okay? As we get later in the year to see the dollar amounts, like I said, if you want to risk 4%, this would be $4,000. If you want to risk 4%, this would be $6,000. And then it would be a 12% return. This would be a 10% return if you're risking $4,000 rather, excuse me, if you're risking 4% rather than 2%. I wouldn't recommend risking more than 3 to 4%, but it depends on the size of your account also. At the end of the year, here's what it comes out to. December trading is always kind of weird. You can trade in December, but I would usually recommend just taking December off because it gets inconsistent, weird things at the end of the year with futures. Options, not a big deal, but futures, you're better off taking the month off. Okay, $28,000 risking 2% of the account. This would have been $56,000 risking 4% of the account, 57% return. You're not going to take all the, no one's going to be in every single one of these trades. Let's get real now. However, as long as you try to place as many of the trades as possible, you will see the numbers add up, especially when it comes to the currency futures, which smaller accounts can really trade the currency futures, because you can risk as little as a couple $100 and have a really nice return on your money. So an index future is not too bad either, with the much less margin. You can risk a couple $100 on an index futures trade and have a nice return on that money also. But this is the end of 2020. It is one of my best years of trading ever, because it created, COVID created volatility. The elections created volatility. There is no good or bad volatility when it comes to this. If you have a plan that's 100% objective, we want the markets moving. We don't want the market sitting. No, we want something driving the markets. We want, whether it's shutting down the markets or whether it's the elections and who's going to win this or whatever it might be, we want something driving the markets. If the Fed's getting involved, they want to manipulate the markets because they think they can save us. Great. Now we have a major financial something driving us fundamentally. When we're getting buy or sell signals, and then we get big fundamental changes because the Fed's doing stuff, great. That even backs up, there's more power behind our moves, bigger trends. So perfect. Once again, you always put in your stop loss with a number of contracts. You control the risk. We can never, ever have a big loss. As long as you control your losses and have them fixed loss, the wins will take care of themselves at 80-something% winning trades. The wins will take care of themselves. You control the losses. You cannot have a big loss. When you have a big loss, it's usually because you messed up, moved your stop, haven't had an error. Going to 2021, starting out the year, great. Basically no losses. And we get these runs like this, okay? 12% return. If this was a 4% risk per trade, then this would be a 24% return. Okay, so that's how you can adjust the amount of money you make or lose. Next month we had a couple of losses in there, but as long as you're consistent with your trading, another good profitable month. Now take a look at this. This is a month that's a net loss by a little bit. But think about this. Let's say you're working with me and you started working with me on this week, and for the next 2 weeks, this is what you went through. You made some money. You made some money, then you lost, made some money, lost. And the next month starts, you have another loss. This can happen. Here is where I have to go into coaching mode and convince people that this is normal and that I didn't sell them a bad system. And I get that. People will call me, it's like, it's not working. What's going on? It's like, if you jumped in up here and finished the month down here and will break even, it's different. If you jumped in down here when you started and then had nothing but fail as your first several trades, and you would be like questioning whether you want to continue or not. And this is what happens to people. Sometimes this will happen to them and they lose confidence in me. They lose confidence in the strategy, the system, and I don't hear from them for a while. Is because they stopped trading, they lost confidence, and they said, I'm not doing this anymore. And then I talked to them months later and I showed them, well, what if you had kept trading? They're like, we couldn't, because we have losses. This is gonna, people think they're gonna have the losses, they're gonna keep losing forever and ever and ever. No. To get to the win, you have to place the next trade. Like I said, you will eventually have 4 to 5 to 6 losses in a row. It's normal part of trading to expect. That's why you have to see the big picture. So you keep trading, and the next month, one of your best months ever. Okay, even if you got in down here and you had a bunch of losses, you made your money back the next month. You're back to break even. Okay, and like I said, these are worst case scenarios. These are not even looking to maximize, but this is just first targets only. If you want to maximize profits, this is just worst case scenario. And you keep trading. get to the end of the year, end of 2021, 55% return for the account, $27,000. If you're risking 4%, this would be $54,000. If it was a smaller account of $25,000, this would be half of this. If you're risking 4% of the $25,000, then you have a really good year. Okay. So consistency, 2022, we had more losses in 2022, 2 back-to-back months of losses. I know some people who were doing this, and the people who were a little more experienced in trading accepted these losses because they understand it happens. The people who were newer stopped. I know a couple of people, they were like, well, I'm not doing it anymore. I can't do it. I got losses. I can't do it. And there are different reasons. Each has a different reason. But it's my job to try to explain and show you the same type of stuff. I got to go back and show this will happen a couple of times a year. You're going to have a couple of multiple losses, and it's going to go on. But you keep trading. The next month, all of a sudden, you just negated those losses in 1 month. In 1 month, you negated the previous losses. And you keep trading. You had a few more losses. This was not a fun year last year for trading some of the strategies. The currencies were profitable. The index futures were not. That's why you trade more things, because one will offset the other. When it's all said and done for the year, it was a small percentage return. And if you, once again, if you don't trade in December, big difference in this number. This becomes a 10% return because we took a 6% loss for December. Literally, December is a month where you just take off from swing trading the strategies, because a lot of market manipulation, there's rollover, expiration, quadruple witching, and then the holidays. There's just not a lot of good trading because everything's kind of messed up with the end of year holidays plus rollover and quadruple witching. Not a lot of good trading days. So this could have been a 10% return by not trading December, but we put on here worst case scenario so you understand the big picture and can see it. Maybe I take December off. It would be smart to take December off from trading. But so people can make a choice, or trade smaller size in December if you do want to trade, but still a profitable year. And here we are in 2023. January, really good. February, really, really good. Solid trades. We had one slight losing month. Once again, as long as you're consistent with your trading. If you're not consistent, it's possible you might trade these 2 losses, but you miss 3 or 4 wins because you're not being consistent. So if you are consistent, you're getting all your trades. Someday, if you're not consistent, then it becomes a little more luck of the draw, because you might have taken these 2 trades, gotten losses, but you might have been doing something else and missed a couple of the wins. So it is what it is. So some people might get some different results, but if you're consistent with your trading, it all comes out nicely. And through end of August, this is where we are right now through the end of August. If you're trading 4%, this would be $18,000. Okay. And a 19% return. And this would be a 36% return if you're risking 4% of the account, as opposed to 2% of the account. This is all with strict risk management and taking first target profits also always. So how we had gone over on the chart, the same calculation of percentage return is how we do it on all of these strategies and all of these trades. We calculate our entry price, and that's stated in the trading plan. Our stop loss is stated in the trading plan. Our first target is defined, that's stated in the plan. And we calculate our risk and a number of contracts the same way we calculated those number of contracts. And that's how we trade, control risk. But it all comes down to having a plan where you know percentage wins to expect. So maybe you'll be working with me on these strategies. Maybe you're working with someone else. I was asked someone who was going to work with me. I talked to them, and they didn't know what questions to ask me. So they asked someone else to contact me to ask me questions. They didn't know what questions to ask. And I always tell people, if before you give someone money to coach you, to train you, or to sign up for a course or something, that's all, whether mine or anyone else's, number one, ask them, if I learn your methodology of trading, do I need to be sitting in front of a computer at 2 o'clock in the morning? Do I need to be sitting in front of a computer when the market opens at 9:30 a.m. Eastern time? And do I need to be sitting there for 2-3 hours? That's day trading. Some people don't know to ask that because it may not fit into their lifestyle, their schedule, their sleeping pattern. Ask, how much minimum capital do I need to actually be able to do these strategies? Ask, what is the minimum risk in dollars per trade I need to be able to place to be able to trade your strategies? Ask those questions, okay? And come down to personality thing also, which you may not be able to ask the exact right question, but some people like exact execution. Futures gives you exact execution, exact stops, predictable income. When it comes to futures, ask the question, if I do everything you tell me to do and I do it correctly, what is my expected win to loss percentage if I did everything you told me to do and I did it correctly, which no one ever does, maybe eventually, but if I did everything correctly, what's my expected win to loss percentage? And what's my expected profit to loss in numbers? Will I make $1.50 for every dollar lost, $2 for every dollar lost, $3 for every dollar lost? Okay. That is something to ask and see if they have an answer. If they have an answer for that, it means they actually trade what they're saying they trade and not just teaching. If they don't have an answer for that, then they're just teaching a program. People who actually trade their own strategies and teach you to trade their strategies will be able to give you numbers for the P&L. Let me show you real quick what I mean by that. On the handout, let's see, next, for the sample trading plan. That's 1 second. Okay, new share, screen 2, futures, there it is. See where I have here in trade management, P&L. This is telling me that with this strategy on Australian dollar, over time, since 2003, it makes $2.30 for this particular, it makes $2.30 for every $1 lost. For our strategies, it varies anywhere from $1.90 to what, $8, $9 for every $1 lost, depending on the strategy. They should be able to tell you this. Okay, ask that question. How much do I expect to make? Sometimes you might hear people say, well, I'm going to risk 1 to make 3. Yeah, good luck with that. That means you're going to have about 60% losses because you're only going to, means you're trying to triple your money. That only happens 30 to 40 something percent of the time. Can you psychologically handle being a loser 60% of the time? And the reality is no, because you're going to be taking a lot of losses and you don't actually make more than this. You ask them, if they tell you that, what's the P&L expected? Most people won't be able to answer that, but it's a good question to ask. This we can answer because we have 20 years of data for everything we do. All right. Do we have any questions on anything so far? I cover a lot of stuff usually, but when I work with people one-on-one, we get through a lot of information and the trading plan, and then we get the live trades. I email out to everyone the trades valid, which we found valid every day, so they can compare it to what they find valid, because it takes a learning curve just to be able to look through the charts and figure out the strategies. So we support those, all the people, by emailing out, here's what the trades are, which we found, and then I help you as much as needed, everything one-on-one. Okay, Olga's asked, what do you know or think about prop accounts? That's not something I deal with. Are you talking about those accounts where they fund you to trade, Olga? Is that what you're talking about? Or something else? Yeah, they want you to trade their strategies with their risk, not your strategies with your risk. That's the difference. I had a couple of people who are doing that, and they're having trouble because you can trade your strategies, but how much they risk on a trade is different than how much we risk on a trade. So if they see you place a trade and it's a loss, they yell at you, because cut you off or penalize you by locking your account down for a week because the risk exceeded what they want you to do. They really want you to trade their way. So they get a big percentage of your profits, number one. Over time that changes, but they want you to trade their way with their risk. And everyone I've known that's been trying to trade our strategies can do it, but they can't risk more than about 1% of the account per trade. I know someone literally doing that, but what they found, they could not put forth a risk of more than 1% of the account they were trading. So there's nothing wrong with it, but if you can avoid it and trade your own money, great. But yeah, they put a lot more restrictions on you. So you might, with us, we might have 5-6 trades going on at the same time, and they might have a certain amount of drawdown, and they say, well, your overall drawdown is too high, so we're going to shut you down and you can't trade for the next week. Slap on the hand for you went beyond their risk allocations. Remember, it's their money, so they make the rules. Whoever has the money makes the rules, same as in real life. That's the way it is. All right. Okay, so if any, I put in here for that same bear attack strategy, these are all the valid trades over the last 20 years, basically, so that, which you can reference on your own. It's 85% winning trades with the same strategy on, this was on Aussie dollar and euro. So we put Aussie and euro are our two favorites to trade, by the way. So we put all the Aussie trades and the euro trades on this spreadsheet that you can reference, and you can look for the crosses if you have the charts. If you're working with me, I'll give you all the charts and the setup. If you're interested in working with me on this, I charge $17.45 for the futures, and it's at least 10 plus strategies which work in conjunction with each other to get all the trades shown. You don't have to trade them all. You can trade some of them, you can trade all of them. It's good if you can trade all. The more you can trade, the better off you will be. Or you can get more focused. If you just want to trade currencies, great. If you want to trade index and currencies, great. If you want to trade certain indices, certain currency strategies, a combination of the two, great. Just be consistent. Whatever you do, keyword is be consistent, and you'll see the results come out in your favor. I do everything, like I said, one-on-one. I prefer to meet with you in person if you're in the Bay Area, but I do stuff on Zoom wherever you are at. But it's always good if I can meet you in person, get your computer set up just right. And I give you as much help as you need. If you, on the first time you're placing a trade, if you need me there with you, I can get on a Zoom call with you, make sure you fill out your order form correctly. The hardest thing is filling out the order form right the first couple of times. I'll be on the call with you, make sure it's all filled out correctly, and talk you through everything as needed. I'm always available by email. Is the easy way to reach me, or pick up the phone and call me. Literally call me. Leave a voicemail if you don't get me. Call. Use the phone. Don't text me. No, I don't give out my cell phone to people usually. I fundamentally don't believe in having someone punch 10 numbers into a device and take control of my life. I fundamentally don't believe in that. if I can punch 10 numbers into a device and take control of someone's life, there's something off there. So call me, leave a voicemail. I'll call you back. I'll set up a time when we can chat. On my website, tradingbehindScenes.com, you can use a contact form to also message me there. I'm going to switch this real quick to share. I always want to do a shorter presentation, but it always ends up going longer than planned. It's just the way it ends up being. Okay, so you can use a contact form. This is a good, easy way to do it. We place valid trades on this sheet. If you haven't watched it yet, this is another future strategy on the long side. A video of that to watch on the homepage. This was a podcast I did a couple of months ago, and it's about 30 minutes to give you a lot more insight into how I think and how we approach trading and my viewpoints on the markets and how we go about making money, and about how I approach, how my different engineering background and martial arts background all come into play as a trader. Okay, and if you go down a little bit more, there's another video here that you can watch. I think this one is an options workshop. This is one from futures, and a big overview of some option stuff here. And on the scheduled coaching program, I have the details the same as it's in the handout, options, and for the futures. So just call me, message me if you can do. This is the end of the year, which is between now and the end of November is the best time to trade for this year. And then again, starting in January. December is sketchy, okay? If you want to work with me on this, contact me ASAP. Let's get this started right now. Let's get you into the strategies right now so you can be ready. We got a lot of sell signals the last couple of weeks. We've been short. We're waiting for those buy signals. We're waiting for those first buy signals. They haven't happened yet. We're waiting for them, okay? So good time to contact me to really get ready for this. So when these markets turn up again, we want to just crush it on the way up, and then when it turns over again, kill it on the way down. We want to be in every trend. Okay, so good time to contact me to work on this. And so from now till the end of November is the good, sweet trading time. Not December, but then we start back up again in January, and then we look forward to the next couple of months of good trading after that. But we're in this perfect time. I look forward to every year. The end of the year is our best trading time. So good time to contact me to get started on this. So let me know in the next couple of days. I'll take $100 off this price if you let me know before the end of this coming week, before the end of this week. So it'll be $16.45 anyone on the meetup. And if you want to do futures and options, I'll take $500 off this price for futures and options. Even trading both is actually a good deal because you're always making money at some point in time on something. So $500 if you do the combination, and $100 off if you just do futures only. But you have a good feel now for how we trade futures and how we manage risk and how we profit and what to expect. That's what I like to do, show people how we actually make money. All right. You have any questions, anything? We probably have maybe 2 more meetups this year, one in October and one in November. And then that'll be it till January. I'll probably do one options meetup in October, or should I do futures? It might be either one. I'm not sure which one yet. If you got a preference, let me know. And then one more in November. All right, I'm going to cut it off now then until our next meetup. If you want to contact me for coaching, let me know ASAP. We can get you started, and I can either meet with you in person or on Zoom. But great time to trade end of the year. I always say it, including in all the meetups and on the thing I send out on all the information I'm emailed out. This is the end of the year. We look forward to October through April. October through April is the time we make our money, the most money. All right. Talk to you guys soon then. if no questions. If you want to, or call me or email me if you want to talk. All right, guys, have a good day. Stop the recording now. I'm going to send the recording out a little bit later on.